Hi, welcome to Elements in Focus. Today we're going to be talking about why staying invested matters more than perfect market timing. If you're tuning in for the first time, or if you've watched Grant and I and the advisor team over the last few years, we are going through our five critical element process to where we break things down, have a topical conversation. Today we're covering our investment playbook. And this question, Grant, gets asked a lot.
Right.
If we could have our crystal ball and just go back in data or do the back to the future and figure out when to time the market from the top to the bottom, you and I would not be sitting in our seats. We would be taking over the world. So let's just go ahead and dive into the investment playbook side and give some wisdom on why staying invested matters more than time in the market.
Yeah, absolutely, Aaron. This is a big one. And oftentimes, most individuals, Aaron, assume that market timing is the smart move. And on paper, it really sounds logical, right? You
Sure.
wait for a dip, then you avoid the drop, you jump back in when things feel clear and safe. And right, it's just natural human reaction.
Yeah.
Here's the thing. In real life, most market timing isn't driven by data. It's driven by emotion, right? It's that fear when markets are failing and greed when markets are prevailing. And those emotions create this pattern intellectually for us, right? People sell after damage is done and they buy when prices run up because that's what emotionally and inside of our brain tells us the safest thing to do, even though intellectually we know that you buy low and you sell high. So, and here's what most investors don't realize. And Aaron, we've covered this in the past,
Yeah.
right? The biggest long-term cost of timing the market usually isn't being wrong once. It's missing out on a very few handful of days that have really strong market performance. So, for example, there's a group of, I would say, analysts that our firm has access to and that we follow. And they provided us this study once. And I went back into our Wayback Machine, Aaron, and found this. And so from 1980, so to give some statistical data to back this up, from 1980 through 2022, a $10,000 investment in the S&P 500 could grow dramatically. But here's the kicker.
Hmm.
If you missed just 5 of the market's best days in that time period, you reduced your entire portfolio balance over that period of time by 38%.
Holy smokes.
Think about that for a second, folks.
Yeah.
From 1980 to 2022, a $10,000 investment would have accelerated, right? Good times, bad times in the markets, we can, as we all know. But if you'd missed just 5, the 5 best days in the S&P 500 at that point in time, a total of a 38% reduction. So it's not a small penalty, folks. The difference between compounding working for you and compounding interrupted is that data right there. And what makes this even harder is that the market's best days rarely, Aaron, we've talked about this for years, rarely show up when things feel safe. They often
Hmm.
happen during periods of maximum uncertainty, when headlines are very loud and emotions are at their highest. And Vanguard even takes a stance when they make this point and they say that staying invested through turbulence can matter most during the recovery because missing only those few key days, which you just covered, can have meaningful changes to long-term outcomes. And this is what we tell our families, right? The goal isn't about prediction, it's about participation. And our allocation team that does the weekly market carver has said this numerous times as well, right? Headlines create urgency, folks, and they feel like we have to do something. They make us get up out of our seat, our blood pressure rises, and we feel like we have to go engage in something. But most of the time, nothing really meaningful has to change in the long term plan because if you're doing it right and you know your appetite, overall tolerance for risk, right?
Hmm.
Not just what you can do in the market, but your overall tolerance for risk. If we get that right, right, that's what matters more. And so Dalbar, which is an investment behavior research company, found this out as well. They analyzed all of the average equity investors in 2024, and the criteria to meet for this average equity investor was these individuals that are all in stocks. So they're all in stocks, 100% of portfolios in stocks. So when Dalbar did the research in 24, they found out that that group, all in stock pickers, they earned only about 16.5%, while in 24 the S&P earned 25%. That's
Hmm.
an 8.5% gap. And so what they found was that gap was largely driven by investor decisions, emotions, not actual process. So if you get it right, meaning your risk tolerance, right? Real investing is not about having an edge on brilliance. It's about discipline.
Hmm.
Consistency matters more than reacting, especially during volatility, because when you stay invested, you aren't just holding the portfolio, you're protecting your opportunity to compound over time. So, Aaron, I want to take a different approach to discussing that topic
Yeah.
because we've been hammering this for years and it still comes up constantly. And for folks, it's just the data's out there. It's real. It's participation. It's not trying to find the brilliant strategy or solution. It's knowing what your appetite is, what your tolerance is for that risk, and approaching it successfully.
Great points, Grant. And, we have these conversations all the time. Markets go up, markets go down. It is very, very behavioral when the markets go down because you get
Mhm.
attached to that statement balance and no one likes loss.
Sure. Oh my gosh,
It
yeah. I
doesn't
hate
mean
loss.
that we don't react or we don't recalibrate during those periods of time, but it's our job not to panic. It's to take the emotion out of the investment situation, digest it, and react accordingly, not in a panic. So, markets go up, as I said,
100%.
markets go down. If you want a review of your overall allocation, schedule a complimentary next steps meeting. Talk to us at 800-928-4001. You can go to talk to FEG at Your Life After Work, send your questions there. And if you want to get on one of our advisors' calendars, which I highly recommend you do, schedule a meeting through that QR code that you can see on the screen, or go directly to us at yourlifeafterwork.com. We will sit down with you for 90 minutes, review your situation, give you things to think about today, things to think about in the future. And if you decide to partner with FEG, a written plan of what we will do for you going forward. Thank you so much for watching. You all have a blessed day.